Welcome to Market Monday from the investment team in the trust department at the First National Bank. We have a lot of important data and events over the next couple of weeks, things that could really move the markets. So we want to get into it and we want to set the tone up front and talk about these things. Later today, we are going to get the Purchasing Managers Index, which gives us an idea of what the business outlook is. We're getting factory orders and durable goods orders information. That tells us the strength of demand for big ticket items. We're going to information about the trade balance, our imports versus our exports, the labor market, wholesale trade, consumer price index. This will be a big one because up until now or recently, there have been widespread expectations that the Fed was going to at least pause and not hike at its rate decision later on in the month. And in fact, most of the economic reports that have come out recently telegraph inflationary pressure is still not fully under control, and there is a very non-trivial chance that the Fed is going to raise rates again at the June meeting instead of hiking, or at a very least pause and maintain a very aggressive stance in their language. That's followed the next day by the Producer Price Index, which is expected to show a decline. And if that does show positive, that comes in the early morning, you could see the market react negatively to that because it would indicate again that inflation is still too strong, raising the odds that later in the day at the FOMC, the Federal Open Market Committee's rate decision, that instead of this expected pause where they maintain, this 5 to 5.25% bound around the rate, maybe they hike another quarter basis point, and it's based on the recent strength that we've been seeing. That could be a market moving event if that does occur, and we're watching it very carefully. Afterwards, it's a little bit less important. We get more information about industrial production and sentiment and the labor market and the real estate markets as we round out the next couple of weeks. But let's talk about the really big story, which is the S&P 500. And we're not chartists, we're fundamental investors, but this market is now approaching, despite all of the recent economic reports going on in this period right here, where things have been rough. We had a banking crisis a few months ago. We've had, inflationary data come out that suggests the Fed isn't done hiking. This market just can't seem to want to go down, and in fact has conclusively broken above a level that it hasn't been at since August of 2022, and it's getting very close to that level. If it can get and stay above there, that would mark, in our opinion, the end of the bear market, and a convincing argument that the end of the bear market of 2022 has already occurred could be made. In terms of rates, the yield curve has shifted up higher. This is good for retail investors and bond investors who can now get almost 5% on the 5-year paper, and then over 5% if you go out past 10 years. So, and that's on average paper. Some sectors you're going to get more because of a risk premium embedded in there. But that said, that's a good situation for the income investors. So we have a good situation for the equity investors. Market showing a lot of strength with a lot of bad news, which is a bullish indicator. We have rates that are at a pretty high level. We have a Fed that will combat inflation and get it back under control. And the expectations do show that while we see a 65% probability of recession based on what we're seeing with all these indicators, we also see inflation coming back to 2.5% in 2024. So coming back to it, is the Fed done hiking? Maybe not. And they may maintain this aggressive stance through the end of the year. We put a very low probability on any odds of any rate cuts in 2023. But again, always zooming out to the bigger picture, the fluctuations that go on the shorter term are of less importance to us than what's going on over the longer term. You've made investment plans with the long-term time frame. If we look at 20 years, that's an average annual rate of 7.5%. So we're not going to make short-term or adjustments based on short-term information to really good long-term plans. If you have questions about your investment plan, if you have questions about what's going on in the market, feel free to call us. We'd love to talk. Hope you found this video useful. Thanks, and have a great day.